Hello everyone, Greg here from Master Trader. I wanted to go over with you a chart of ExxonMobil today and a option strategy that was recommended. Actually, the recommendation came from Tasty Trade, which puts out recommendations and statistics on option strategies on a daily basis, many of them. Their approach is one that is just based on statistical numbers, which it's Tasty Trade's opinion that technical analysis has no place when it relates to option trading, that it just does not work. As you know, that is not the approach of myself and Dan and Master Trader. Actually, our approach is one completely in opposition of that, in that our option strategies revolve with the technicals. And here's a prime example today of a recommendation that was put out there, a bearish recommendation where the chart is in total opposition of that bias, and that it was a bearish strategy where it says right here on the chart, a long put vertical that's short the 82.50 put and long the 87.50 put into the February expiration. Based on the statistics, however they came up with that, this is not my point of expertise. I look at the chart, but to come up with statistics that say it has a 58% probability of making 50% of max profit before expiration. The chart does not agree with that whatsoever. And this is what I looked at this morning, looking at that recommendation in this chart, and I was like, this is certainly not going to work out unless some disaster happens, and probably today where the stock possibly gaps down. This strategy doesn't take into consideration that whatsoever, since it doesn't even look at the chart. But as you can see, what's happening here, and I'll explain this, the chart here, is that Exxon was moving up. And of course, the price of oil having moved up for several months is certainly helping that. And even though the price of oil was moving up, that didn't help Exxon at this point, where it had this correction falling sharply under even the 200 period moving average. However, it did stop at this area of price support, which is what I say is the real or actual support, not the moving average. And this is a perfect example of that, using a subjective reference point like a moving average, and then seeing it actually turn around. This often confuses those that look at moving averages as actual support and resistance to see how prices can turn like that after actually slicing down through it. Now, happened in addition was that once it rallied back up into this resistance area, it stalled, which would be expected, and possibly even pulling back down to the 200, would then be in alignment with this little support area right there. But rather than pulling back, it actually went sideways. And this consolidation at this resistance area, this is where there's sellers, that sideways consolidation, in addition to these red candles, which tell us that sellers took control and buyers stepped up again and pushed prices up. And as it came up into this new resistance area that was created, we see that sellers came in again. Notice the topping tail, pushed prices down, and buyers came in again. This sideways consolidation, which is actually absorbing the supply, where the sellers are right here, is extremely bullish. And then as prices moved up, they went sideways again. So buyers continued to step up after moves down, after moves up. They don't wait for pullbacks to support. They actually step up and buy at resistance. It's extremely bullish price action. And then at prices broke out above that with a wide range bar, there was an increase in volume, not a huge one, but an increase in volume. All of this suggesting that prices were going to move higher, and there is no immediate resistance to the left. This strategy, this bearish strategy, flies totally in the face of the technicals setting up at the time, and in our opinion, a foolish trade to put on, regardless of whatever the numbers were suggesting. And what happened today? Prices actually continued to move up, and moved up sharply up into the area of that 87.50 put. So this strategy in one day lost approximately 35% of its value. And this pattern suggests that it's going to continue to move up. Now, should it move up a third day in a row, and especially if it's a wide range bar? Absolutely. This is very likely to stall. However, the likelihood of this coming back down significantly, especially under this base, is almost nil. It would require some disastrous news on the stock, and as long as oil stays steady up into the area where it is now, and it's likely to do that. Here's the price of oil. Oil is in a bullish trend. As it pulls back into areas of support, buyers step up. As it moved up and pulled back again, buyers stepped up again. It breaks out, consolidation at the top of a wide range bar, and prices push up again. Everything is in bullish mode here to the intermarket analysis, this commodity moving up, supporting energy stocks. In addition, yes, a lot of the energy stocks were lagging last year while oil was pushing up, but they're coming on strong now. And this looks like it's going to be a theme of 2018, where energy stocks were the main underperformer sector in 2017, very probably coming the outperforming sector in 2018. So that being said, Exxon moving up as it is, it just is another proof that technicals are a very important part of the strategy that should be incorporated into your options strategies. And to ignore that, in our opinion, is just asking to lose money. I hope you've enjoyed this. Visit mastertrader.com. Take a look at our option strategies course, which employs all of the technicals combined with option strategies in addition to Master Trader technical strategies. So, happy trading, everyone. I hope you found this informative. If you have comments, email Greg at mastertrader.com, Dan at mastertrader.com. Happy trading, everyone.